Master options risk graphs. We're going to turn you into an option trading fiend. You're going to be able to draw risk graphs by hand. We're going to teach you how to diagram these things within just a few minutes of watching this video. Will you be an expert? Probably not, but with a little practice, this will go a long way. So let's get into what risk graphs are and how they work. Here I've drawn up a simple risk graph. All I've done is put a break-even line. You can see the dotted line. This is where, as the risk graph corresponds with that price, you would be breaking even. Down below, you've got your losses. Up above, you've got your profits. This area is called the y-axis, right? That's the vertical area. Profit up here. So if you're above the break-even, you're profitable. If you're below the break-even, you're at a loss. Down at the bottom along the x-axis would be the price of the stock, and that will correspond with lower prices to higher prices. Now, I haven't written them in yet, but we could do that manually, and we can put in some hypothetical stock prices. We would simply draw them onto the chart. So if I put a line here, this might be $50 per share, and then this might be 52. And this might be 54, and on we go, right? They would be spaced out in $2 increments. And you can make this risk graph however you want it to look based on your time frame. Now, the nice news is that a lot of brokerage platforms actually have risk graphs for you. You can simply pull them up and access, and it will show you this. But if you're able to draw them by hand, then you clearly understand and know about the strategy. Any strategy that you take in the options market would have details. There would be break-evens and so forth. So let's just do a hypothetical. Let's say that we went out on IBM, and I don't know the exact stock price, but let's say it's around $200 per share. And we decide that we think, whoops, I better not say $200 per share because we already drew in some prices down below, right? So we're going to say that IBM, which is not, by the way, but let's say that it were trading at $55 per share. Maybe it went through a stock split, right? And it doesn't matter what this symbol is. It doesn't really matter what stock price it is. We're just going to graph something that would be a representation. Now, maybe we think that the stock is going higher, and as it goes higher in price, we want to be profitable. We understand that if we put on a trade that targets an upside move and the stock goes down, we're going to be unprofitable, right? So every trade has a profit and a loss zone and a break even. Well, a very common strategy is a bull call spread. This simply means anytime, it's called a vertical spread because you're going to trade the same expirations. Let's say that the expiration was March for both of these options. It's a simple spread trade. In this strategy, you always buy a lower strike call and sell a higher strike call. So maybe in this example, we buy the 55 call and we sell the 65 call. So we have on a $10 spread. Maybe in this case we pay $4 for the trade, what we call a $4 debit. So now we have the details of the trade. And this is where it gets important. In a bull call spread, whatever you pay for the trade, you can add that to the long call strike price, and that'll give you your stock price break even. 55 plus 4 equals 59. So that's going to be my break-even stock price. Max profit in this spread is if the stock is above 65. Max loss is if the stock is below 55. So how much can we lose? $4. That's $400 per spread. So I can take a flat line here at $4, and let's change the color. I'm going to lose $400 if the stock is at $55 per share or lower. So notice I'm going to stop at the $55 price point, which would be right in between those 54 and 56. That's my loss area. What's the most that I can make? Well, it's a $10 spread minus our $4 cost. We can make $6. We can make $600. How do we do that? Stock needs to be at 65 or higher. So if I go to 65 and I come all the way up to $600, which is about right there, I can do a flat line on this side. And it doesn't matter how high the stock goes, my gain is capped at 600 bucks because a $10 spread can trade between 10 in value and 0 in value. If it goes to 0, we lost 400 bucks. We lost what we paid. If it goes to $10 of value, we're getting $1,000 back for the spread and we spent 400. That's a $600 profit. So our break even is at 59, lower strike plus the debit, that's 59. And now these lines would go right through 59 and connect up like that. And then you have risk graphed your trade. The break even's at $59 per share. Max loss, this corner here, is at 55 and below. Max gain is up here at 65 and above. And any strategy that you take, as long as you understand the dynamics of the trade, you're going to be able to risk graph it. So vertical spreads, bull call, bull put, bear call, bear put. There's 4 types of vertical spreads. Those are very, very common trading strategies. Here's the simplest approach with any vertical spread. When you're trading a vertical spread, one of those 4 mentioned, you always know that max value is the full amount of the spread, minimum value is to 0. What does that mean? If I trade an 80-90 call spread, it doesn't matter whether I'm long the call spread or short the call spread. The max value is 10, the minimum value is 0. That's true whether you're bullish or bearish on this call spread. It's a $10 wide spread. It could go up to 10 in value. It could go down to 0. What does matter now is which side of the trade you're on is which way you want it to go. If this is a credit trade, a credit spread, we're collecting our money up front. So maybe it's going for $5. What do I want to have happen? I want it to then proceed to trade a 0. I've already collected my $5 credit. If it goes to 0 and expires out of the money, I don't have to pay anything back to the market for this spread. That is my profit. If the spread goes down in value after I have collected the credit, okay, after my line went a little wonky, after I have collected the credit, my max profit is if that trades to 0. What's my risk? My risk is that it trades up to 10. In this case, I've got $5 of reward and $5 of risk because I entered it right at the midpoint. What if we did an 140 by 120 put vertical? Okay, it's a $20 wide spread. Max that spread could ever go to in value is 20. Minimum it could ever trade to is 0. What do I want to have happen? Well, maybe in this case we buy a debit spread. Maybe we spend $6 for the trade. When you buy something, you want its value to go up, right? Selling is a credit spread. Buying is a debit spread. So I bought at 6. If it goes up to 20, I've made $14 of profit. If it goes down to 0, I have lost $6 of value. In this case, we've got $14 of potential profit, aka I would need my risk graph to go up to 1,400 to represent that. Over here, we've got $600 of losses. This would show the loss side. It just wouldn't stretch enough for the gain side. So how do you risk graph vertical spreads? You understand this point first, that a vertical spread can max out at its peak, its full spread value. Let's do one last example here to make sure it hits home. Let's say we go out and we trade, and I'm going to do a really wide one. We trade a 200 by 250 call spread, vertical spread. What's the most that this spread could ever go to in value? $50. What's the minimum that a spread can ever go to? That's always 0. So this is a $50 wide spread. If I buy the 200 call and sell the 250, or I sell the 200 call and buy the 250, I'm doing the debit or the credit. That matters in terms of my outlook. But to this point, it doesn't matter. It always can go to 50 or it can go to 0. Period. End of discussion. Now, you're taking one side of the trade or the other. Let's say in this case, we did, again, a debit spread. We buy the spread. Maybe we spend $10. So if I buy this at 10, what's the most it can ever grow to be worth? 50. So I have $40 of upside. In options, that's times 100, so I have $4,000 of potential profit. I don't love how that last 0 looks. I have $4,000 of profit per spread. What can I lose? Well, if it goes to 0, I spend $1,000. I'm going to lose the $10 I paid times 100 shares, which is what one option contract controls. I've got $1,000 of risk and $4,000 of upside. So how do I need my risk graph to look? This one will not be sufficient. I would need it to go as high as 4,000. Maybe I'd go 4,500, 4,000, 3,500, and on, right? We would draw the risk graph so that it fit, and hopefully I can fit this in. But it would look something like this, where each subsequent climb is a $500 additional profit. Okay, and there's your break even, and then it would need to go down as well. And I don't really need it to go beyond 1,000 because that's my max loss, but usually the risk graph would show the same drop here as profit there, so it would go all the way down to 4,500. But here's the point. On the bottom end, how do I risk graph this? Well, I would need my chart to show below 200 all the way up to above 250 because I need to show this entire trade, right? So I would need to draw my risk graph. Now we're doing it by hand, so you learn a little bit more. But I would need my risk graph to show the spectrum of the trade. And now I can risk graph it. I lose $1,000 if the stock is at $200 per share or lower. So I would have a flat line at $1,000 loss from $200 per share and below. If the stock goes down, I'm going to lose $1,000. But if the stock can get to 250 or higher, I'm going to make $4,000. So $4,000, come over here to $250 price point. Let's get those to connect. There's my profit of $4,000 if the stock finishes at $250 per share or higher. It doesn't matter how high it goes, 280, 290, 300 per share. I'm still at max profit. Break even would be 10 added to the 210 or the 200, so that's 210. So my break even would be right in there. These would connect up like that, and we have risk graphed a bull call spread once again. Max losses, this corner will be one of the strike prices. This corner will be the other strike price, and your break even will be somewhere in the middle of those. You can see here a lot bigger profit zone than risk zone. So this is important stuff that you really understand the dynamics of any trade. And I've done this obviously for many, many years, but any strategy now I can visualize it in my head. So if I go out and trade a 30, 35, 40 butterfly and I pay $1 for it, I know immediately my break evens are $31 per share and $39 per share. So 31 might be here, 39 might be here, and I would need my risk graph to show Here's 41, here's 40, here's 39, right? That's one side of the break even, and over here would be 31, 30, and so on. And then my max profit would be around $35 per share. That's the body of the butterfly. And in this case, we paid $1 for a $5 wide spread. Max gain is $400. Max loss is $100 if it's at 30 or below, or 40 and above. So then I've drawn my risk graph. At 40 and above, I'm losing $100. At 30 and below, I'm losing $100. Max gain is at 35, which is a $400 profit. And voila, we have our butterfly risk graph. If the stock is between 31 and 39, we're going to make some money because it's inside of the two break evens. Think about how quick I did that. I didn't time it. Might have been a minute and a half at most. So visualize these trades and be able to draw those risk graphs like a pro. Now don't forget to hit that subscribe button so that you'll get content like this whenever we send it out. Have a great rest of your day. We'll see you in the next video.